So that in terms of the structure, we can just briefly draw something brief over here that can drive the point home in terms of private equity funds there. So we have three rectangles. I've already drawn this before. Should be not be able to struggle so much in trying to understand this. All we are saying is that we need to have a general understanding of private equity arrangements. So here we have the investors right over here. So the investor, the investors, they pump funds, so they invest. So they invest. Hope you can see that. Yes, you can see it. Invest in the PE fund, the P/E. This is not price to earnings ratio, terming it as the private equity fund, like that, who identify individuals or key persons who are experts in their own making, and then they invest. They invest in what? They invest in portfolio of companies. Port of companies, like that. And then in return, what do they get? They get partnership, interest partnership. Then they get equity position. An equity position like that. So this is a general diagram of how private equity arrangements actually work. Investors pump money into the company called TransCentury. They are able to generate, they are able to identify individuals and experts under the private equity investments airspace who can be able to now identify potential companies for investments, invest in portfolio of companies like that, and in return they get partnership position interest and they get an equity position like that by extension like that. So we can say that the timeline starts with the sponsor getting commitments. With the sponsor getting commitments from the investors. From the investors at the beginning of the fund. At the beginning of the fund. The beginning of the fund and giving capital calls over the first 5 years. Over the first 5 years. Then we continue, guys, and say that the sponsor remains. The sponsor receives compensation in 3 ways. Receives compensation in 3 ways. This is who we're calling the general partner right over here. These are the investors over here. General partners, limited partners. General partners, limited partners there. So let's recap what we've just said. That the timeline, this keyword there, the timeline starts with the sponsor getting commitments from the investors at the beginning of the fund term of the fund, and giving capital calls over the first 5 years. So we're saying capital calls relates to if an investor decides to recall back the money, that's what we're terming as capital calls. So capital calls over the first 5 years. Then we say that the sponsor receives compensation in 3 ways. Receives compensation in 3 ways. The first way, guys, be very attentive, is by returns. Number 1, returns generated by the fund, guys. Generated by the fund in form of return on investment. Return on investment. Number 2, we are saying management fees based on assets under management. Management fees based on assets under management. That. Third way, guys, is incentive fees. Fees. So we are saying on incentive fees, these relate to a share of profits, relate to the share of profits. Share of profits, usually 20%, 20%, which is part of the managers, which is paid. I think it's, yeah, that's the keyword. Not is not part, pardon me. It's paid to the managers. Paid to the managers. Which is paid to the managers over there after the fund. After the fund has returned to outsiders, You can say outside investors, outside investors. Pardon me for that, guys. Outside investors, capital. Outside investors' capital. Let's recap, guys. We're saying that right over here, the sponsor receives compensation in 3 ways. Number 1, returns generated by the fund in form of return on investment. At that point here, so you invest 1 billion shillings in one portfolio of company, you end up getting return on investment, and you're saying that the value of the company at that time of pumping in the value is maybe, say, about 1.5 billion. And then we are saying that after a period of 5 years, you see the value of that company is actually translates to around 7 billion, like that. So the difference between the amount of capital committed to that company and the amount of the value of the fund of that company after the end of 5 years is what you're saying is return on investment. Returns generated by the funds in form of return on investment. That's the first way of compensation. Number 2, management fees based on assets under management. We are saying it's usually between 2 and 4% on assets under management. So if you're managing a portfolio over here, portfolio of companies of worth maybe say 15 billion, like that, you're saying that the management fees usually charge maybe say 2%. The general partners usually receive 2% on the value of the portfolio of companies. That's how we're saying management fees actually work. It's based on assets under management there. So I can be able to know assets under management, or what you're saying is AUM. Returns over here is in form of return on investment. Those are the keywords over there, like that, guys. Incentive fees relate to the share of profits. It's usually 20%, which is paid to the managers after the fund has returned to outside investors in terms of the capital they've actually committed there.